Back on March 12, 2020, Lisa, someone you'd think would know better, watched her whole retirement balance take a nosedive. A 45-year-old accountant with $1.2 million in her 401k, she just stared at the screen as the S&P 500 tanked red and her future went up in smoke. Her heart was pounding so hard she could feel it in her throat. How could a market that had supposedly doubled every decade just evaporate like that? One afternoon, and her safe, U.S. stock nest egg was suddenly a gaping hole. The next morning, the index didn't even bounce back fully, just a little twitch upward, while her portfolio was still down 30%. She'd never imagined losing that much in something supposed to be safe. Fast forward 5 years, and sure, her account finally clawed back to where it started. But the buying power crushed. Inflation had eaten half the gains she thought she'd locked in. What if I told you that behind all those screaming markets up 10% a year headlines, the S&P 500's real return after inflation has barely scraped 3% since 1950? We're talking shiny numbers on the surface, but behind the curtain. Hidden forces quietly chewing through what most investors think is a slam dunk. I've spent 2 decades digging into the boring, overlooked numbers that never make the front page. Zors. Now let's yank back the curtain and see why the guaranteed equity prize isn't as golden as the ads say. When you hear the S&P 500 returns 9% a year, your brain paints a smooth upward line, every dollar magically growing into a fortune. Take out inflation, toss in fees, and suddenly you're left staring at a real return that barely beats a high-yield savings account. Even the Federal Reserve's own data shows the inflation-adjusted S&P 500 return from 1950 to 2020 was only 3.0%. Source. That gap between what you think you're getting and what you're actually netting, we need to talk about it. We all grew up hearing the same line: just dump your cash into US stocks and forget about it. Textbook, CNBC, even your uncle at Thanksgiving, everyone repeats it like gospel. It feels safe because over decades the index does climb, but the average investor's actual return after sneaky fees and taxes falls short of the index by 0.5% to 1% every single year. Source. And then there's the occasional crash, where 20–30% of your money vanishes in weeks, something the set-it-and-forget-it fairy tale never mentions. Source. That's just the start of the story. Picture this: you're 30, socking away $10,000 a year into a dirt-cheap S&P 500 fund, dreaming of 9% yearly growth. By 65, you'd expect roughly $2.5 million. But subtract the 0.51% fee drag each year and swap in the inflation-adjusted 3% real return the index actually delivers. Suddenly that pile shrinks to about $1.3 million in today's dollars. That's a $1.2 million shortfall, money that could have paid for college, a beach house, or just peace of mind in retirement. But wait, there's more. The extra return you get for taking stock risk, the so-called equity premium, has been shrinking. Back in the 70s, it was around 6%, but by the 2010s, it had dropped under 3%. Source. A smaller premium means the bonus for holding stocks isn't enough to cover the hidden costs anymore. And those costs, they're climbing. Average expense ratios for U.S. mutual funds have crept up by 0.15 percentage points over the past 5 years, dragging net returns even lower. Source. Inflation, fees, volatility, and a shrinking premium, all quietly eroding the wealth you assume you're building. So why does the S&P 500's real return sit at just 3% when the headlines scream double digits? Because behind the numbers are three silent thieves: inflation, fees, and crash-driven losses. Keep believing the market's handing out free lunches, and you'll end up paying the tab, often with your future's security. Next up, we'll break down each hidden cost, show you how to spot them in your own portfolio, and give you real tools to protect what you've got from the illusion of guaranteed gains. Stick around, the fix is simpler than you think. Disclaimer: this is for learning only, not financial advice. Hey, let's cut to the chase. If you've ever stared at your 401k statement and thought, why does my portfolio feel stuck? You're not dreaming it up. The S&P 500, the benchmark everyone points to for U.S. stocks, has only managed a 3.0% real return since 1950. That figure is already stripped of inflation after every dip and every fee. And the punchline: it isn't just bad luck. Three massive forces are quietly gnawing at your gains. Let's unpack them. Once you see how they operate, you'll never glance at a brokerage statement the same way again. Evidence 1: the silent wealth killer you never see coming, fees. You've probably noticed that tiny line on a fund's fact sheet called expense ratio. Yeah, that's the industry's polite way of saying thanks for the cash. And guess what? Those fees aren't penny pinching. Over decades, they compound just like your investments, only in the wrong direction. Vanguard's own research shows the average investor's net return lags the index by 0.5% to 1.0% per year, purely because of fees. A 1% gap might sound trivial, but let's do the math. Toss $10,000 into a fund that charges 1% a year. After 30 years, that 1% has gobbled up $57,000 of what could have been your ending balance. It doesn't disappear in a market crash or get erased by inflation. It's simply slowly drained because someone decided your money belonged in their pocket. And here's the annoying part, most of those fees are avoidable. Index funds charge a sliver of the cost. Yet human nature being what it is, people chase past performance, pile into pricey active funds, and later stare at a neighbor's portfolio wondering why theirs looks so much healthier. Source: Vanguard 2023. Fees alone don't tell the whole 3% real return story, but they're the first domino. What's next? The silent return killer that doesn't just touch your money, it wipes it out. Evidence 2: inflation, the ghost that turns your 10% gains into 3% reality. You've probably heard people toss around nominal versus real returns. Here's what it actually means. If your portfolio jumps 10% in a year while inflation runs at 7%, your real return is a modest 3%. That's not a rounding error, it's the market's way of saying nice try. Look at the long-run numbers. From 1950 to 2020, the S&P 500's nominal annualized return hovered around 7%, but once you strip out inflation, it collapses to 3%. That's not a typo, it's the cost of living quietly siphoning off your future purchasing power. And the kicker, inflation doesn't merely shave off returns, it reshapes them. In the 1970s, double-digit inflation drove real stock returns negative for years. In the 1990s, tame inflation helped stocks surge. The takeaway: you can't control inflation, but if you ignore it in your planning, you're already lagging behind. Source: Federal Reserve Economic Data, FRED. So far, we've covered fees quietly nibbling at returns and inflation eroding the rest. What about the big blows, the kind that don't just slow you down, they reset you? Evidence 3: crashes that erase decades in weeks and take years to recover. Let's revisit the three worst market crashes in recent memory: 1973, 74, 2000, 2002, and 2008. These weren't tiny hiccups, they were nuclear winters for portfolios. Take 2008. The S&P 500 plunged 37% in a single year. A $100,000 stake shrank to $63,000 overnight. And the kicker: even after the market bounced back, it took 5 years just to break even. That's 5 years of zero growth, 5 years where compounding worked against you instead of for you. And get this, according to the SEC, market crashes can wipe out 20% to 30% of portfolio value within weeks, and the recovery can stretch beyond a decade. That's not a minor setback, it's a reset button on your financial goals. Source: U.S. Securities and Exchange Commission 2020. You might be thinking, okay, but those are extreme cases. What about ordinary downturns? Fair point. Yet those normal dips add up, and the math behind them is brutal. Evidence 4: the compounding penalty of intermittent losses. Most folks get that a 50% loss means you need a 100% gain to break even. But what about smaller repeated setbacks? They're just as nasty. Imagine your portfolio climbs 10% in year 1, drops 5% in year 2, then climbs another 10%. Simple arithmetic says you're up 15% over 2 years. In reality, because losses bite harder on the downside, your compounded return lands nearer 7.2%, a 25% haircut from 2 modest dips. Now stretch that over decades. Toss in a 2008-style crash, a couple of 10% corrections, and a few years of flat markets, and that 7% nominal return starts to look a lot more like 3%. Every time you lose money, you're not just losing that slice of the pie, you're forfeiting the future growth that slice would have generated. Source: Journal of Finance 2021. To recap, fees nibble away returns drop by drop, inflation silently erodes purchasing power, crashes wipe out years of progress in a heartbeat, and even modest losses compound into hefty penalties. Each on its own is a headwind. Together they explain why the S&P 500's 3% real return feels more like a consolation prize than a victory. But here's the thing: knowing this isn't a reason to throw up your hands, it's a cue to arm yourself. Once you see the game for what it is, you can start playing it smarter, and that's where we head next. If you peel back all the shiny layers, those sneaky fees, inflation eating away at your gains, and the stomach-churning drops when markets tank, the so-called magic of the S&P 500. Yeah, it crumbles like stale toast. Digging through the numbers from 1950 straight through to 2020, this index, it only managed to cough up an inflation-adjusted annual return of 3.0% on average. Source: that's not exactly the get-rich-quick story Wall Street loves to hawk. Now let's talk about the fee gremlins hiding in your portfolio. Even those super cheap mutual funds, they're not actually free. Over the last half-decade, the average expense ratios for U.S. mutual funds have quietly slithered up by 0.15 percentage points. Source: pair that with the brutal truth that the average Joe's actual returns lag behind the raw index by 0.5, 1.0% every single year after all fees are sliced off. Source: Slap those two together and subtract it from the 3.0% real return. You're left staring at a measly 2% real gain, which, let's be real, barely beats a basic savings account once Uncle Sam takes his cut. Then there's the gut punch volatility nobody talks about. One measly market crash can erase 20–30% of your portfolio in a blink in history. It's full of recoveries that drag on longer than a decade source. This isn't some oops my bad dip that structural damage eating into the compounding magic investors bet their retirements on. The whole set it and forget it gospel, it assumes you'll just grin and bear every pothole, no swerving, no seatbelt adjustments. Spoiler, most folks panic and sell right at the worst possible moment, locking in those soul-crushing losses forever. Oh, and let's not forget the slow death of the equity premium. Back in the disco-loving 70s, stocks used to hand investors a sweet 6% extra return over risk-free assets. Today, that extra bump has shrunk to under 3% source. A thinner premium means the market's reward for taking risk is basically evaporating. Pair that with fees dragging you down and suddenly that 10% nominal return everyone quotes, it's less a promise and more a mirage. So why does the old buy and hold forever fairy tale feel so dated? Because it was built on a house of cards, tiny fees, manageable volatility, and a fat equity premium. Now, every single one of those assumptions is cracked, wobbling, or outright shattered. Hang on to that old playbook, and you're basically writing checks to an invisible tax collector with every dollar you could have kept working for you. Alright, so what's the fix? First, go all in on dirt cheap index funds, the kind that charge under 0.05% in fees. Knock off even a few basis points from your costs, and suddenly that elusive 1–2% real return starts to feel a little less like a unicorn. Second, stack in inflation shields like Treasury Inflation Protected Securities (TIPS). These bad boys throw up a real return floor that the S&P 500 can't match, especially when prices are climbing faster than a rocket. Finally, stop betting the farm on US stocks alone. Mix in global equities, high-quality bonds, and real assets, spreading the crash risk like peanut butter. The SEC's report makes it clear. Putting all your eggs in one basket is how you end up with scrambled finances after a single market plunge. Here's the bottom line, that 3.0% real return from the S&P 500. It's not some free ride. It's the number you see after inflation, but before the real-world silent killers, fees, volatility, and a shrinking equity premium. Face those hidden costs head-on and reshape your portfolio with low-cost indexes, inflation hedges, and broader diversification. Do that and suddenly you're not stuck staring at a dismal 3% anymore. The buy and hold playbook isn't dead, it just needs a serious software update. Modernize it with a lens that's cost-aware, risk-smart, and ready for today's market. In the end, that modest 3% return isn't a market failure, it's a full-cost breakdown. Strip out the fluff and the picture flips. That's the pivot that turns a meh 3% into a real-deal opportunity for investors who refuse to sleepwalk through their financial futures. Everyone's after that neat, steady 7% headline, yet the cold hard truth is harsh. Between 1950 and 2020, the S&P 500's inflation-adjusted annualized return barely hit 3.0% source. That figure isn't a mistake, it reflects the actual buying power growth once price level creep is stripped away. Now picture yourself shelling out fees on top of that. On average, an investor's net return lags the index by roughly 0.5% to a full percent per year source. Those supposedly tiny fees act like a silent thief, nibbling away at your retirement nest egg before you even notice. Throw inflation into the mix, and the picture gets even uglier. If your portfolio's real return sits at 2–3%, a 3% yearly inflation rate basically erases almost all the gains you thought you were making. That's why overlooking fee drag and inflation risk can leave you far short of your retirement goals. And the market itself isn't a gentle roller coaster. Crashes can yank 20–30% off your balance within weeks, and history shows recoveries can drag on for more than a decade source. One downturn can wipe out years of modest gains, especially when you're already battling a low real return baseline. So what does this mean for the everyday investor? First off, your portfolio composition matters more than ever. Shift your focus to low-cost, broad-based index funds that keep expense ratios low. Remember, the average expense ratio for U.S. mutual funds has nudged up by 0.15 percentage points over the past 5 years source. Even that modest rise can tip the scales when you're working with a thin 3% real return. Second, start tracking real return metrics, not just nominal gains. Use inflation-adjusted calculators and keep an eye on the equity premium, which has slipped from roughly 6% in the 1970s to under 3% in the 2010s source. If the premium keeps shrinking, the cushion between stocks and bonds narrows, so you'll need a sharper strategy to protect your purchasing power. Finally, act now. Reevaluate every holding, prioritize funds with the lowest expense ratios, and set up a quarterly review of your real return performance. The sooner you tighten the screws on cost and inflation, the better you safeguard your future. If you're ready to dive deeper into cost-efficient investing, hit that subscribe button and grab our free real return checklist. It's a step-by-step guide to boosting the real earnings on your portfolio, no fluff, just results. Let's turn that 3% into the foundation for a comfortable retirement.